this is a story. DRD Gold, it says here, proposes the acquisition of the remaining 26% of its majority-owned subsidiary, Ergo Mining Operations. You remember Ergo when it was separately listed, Peter Major, but anyway, we'll come to that later on. And also the simultaneous roll up of its black economic empowerment partners as DRD shareholders. On the telephone now is the CEO of DRD Gold, and that's Niel Pretorius. Neil, what's this all about, please? Can you explain the transaction or proposed transaction?
Yes, certainly. We've had this PE partner in this structure, this privately owned structure, or the PTY structure, since 2005. There was always an undertaking that we would eventually roll them up. It was important for us to get some sort of feel for where the regulator was going to take us on compliance levels, the charter and so forth. And we think the time is right now. Value-wise, we think the time is right, and our PE partner, I think, has been around long enough, and there's sufficient consistency in the structure to really bring them up to the listed structure. One of the main conditions, obviously, is that the minister consensus the transaction, and it's got to be a condition mining license. And if we can clear that hurdle, plus if we can get shareholder approval for the transaction, then it should go through.
Okay, so what does it do for your BE status should it be approved?
So the BE status would then be approximately 11% at the holding level, which it's basically on economic terms, it's consistent with a 26% holding at the subsidiary level.
What about Ergo itself, and what about, I mean, apart from the BE side of things, what about the asset itself? Can you tell us more about it?
Well, this is the old Ergo, as you rightly point out, and that's the key asset for our group. We're mining there at a rate of 1.8 million tons per month. The BE partner's been with us through the development phase, the acquisition, the development phase, and so forth. So they took a back seat in cash flows and dividends when we were capitalizing and funding the business. And now that we've basically gone through that and all the capex is spent, the future prospect of having to raise significant amounts of debt or capex, I think we've cleared that now. It's behind us, and the risk of a dilution, I think, is also diminished.
We speak a lot about the larger cap gold mines on this show and throughout CNBC Africa's portfolio. What about the smaller mines? Are there still assets out there that are viable? Peter Major, I'll ask the same question of later on, but from your point of view, are there still some jewels in the small cap crown? Neil, are you still there?
Oh, sorry, I thought you asked the question from Peter. Yes, no,
I'm going to ask the same question of Peter in a moment. I just wanted your view.
Oh, yes, no, certainly. Look, our model is slightly different. We've moved away from the underground mining space, and we're doing the recycling and the retreatment of tailings. And only those assets that are in close enough proximity of our main plants or assets that we could really look at. If one could maybe develop technology to a point where lower volumes are feasible, one would be able to roll that out maybe over a larger footprint. But at this point in time, our focus really is on the 600 million odd tons on surface in and around the Johannesburg area. That gives us ample material to produce for, at least the foreseeable life of our operations.